All right, great. Thanks, Jared. We appreciate you being here, and Kurt as well. See you tuned in. Thanks for helping us set up this event, Kurt. Always enjoy working with you guys, and again, excellent presentation. Kurt posted some links in there for you to check out as well to get further education from Christine. So we had a great first session with Dr. Frank Stanley. Jared just set the bar, I think, even higher. And now we're about to turn things over to Dave Aquino of ValueCharts.com. We had Thomas from Value Charts last Trade-A-Thon, but this is Dave's first time speaking at the Trading Pub, and I believe he's going to be going over some options education for you guys. So Dave, if you can, go ahead and get your screen shared. We will turn things over to you, and if you can, maybe just at the very beginning, tell us just a little bit about how you got started in trading, and then you can go ahead and take it away. And just to kind of give you guys an idea, Glenn, if you're in here, if you can post a copy of the schedule. But Dave will be followed by Mark Sachs of Right Line Trading. He will be followed by Larry Gaines of Power Cycle Trading. So Dave, I will go ahead and turn things. All right, Dave, we're not hearing you. Make sure to check the click the mic icon in the bottom left-hand corner. Okay, give us just 1 second. Yeah, we're working on getting Dave set up with the sound.
Oh, there. I appreciate everybody being patient with me and Kurt leading me through this. I believe that the sound is working now. I hope everyone can hear me clearly and can see my presentation on the screen.
Hey Dave, try turning your volume up just a little bit. It was coming in kind of
The
faint.
sound is going up and down. Bear with me 1 second here. Let me improve my sound quality. Okay. I'm sorry about that. Give me 1 second. There's an echo. How about that, guys? Okay. All right, we're going to try to accommodate everybody as best we can. Okay. All right. All right, better. Okay, so if at any time the sound is disrupted or anything like that, please let me know. I just want to be able to make sure everybody can hear me okay. And I'll speak right into the microphone. All right, now we're through our technical difficulties. I appreciate your time, and thanks for that nice introduction, Kurt. Again, my name is Dave Aquino. I am the Options Live Trading Room Specialist at Microquant. I am have been in the industry, specifically stocks and options, since I was 23, and that's going on 19 years ago. I have been a broker with Merrill Lynch and also in the asset management department at the Vanguard Group. And we used to manage large client portfolios of stocks and options so that we would manage the cash flows. And a lot of the strategies that I was familiar with dealing with options would be used to generate that income flow. So I've been trading options going on 10, 12 years now. And so I've been with Microquant going on about a year now, trading with them for about a year. I've been running the options live trading room for roughly 9 months. And we have a good group of people in that room, and we trade every single trading day together. So it's a good opportunity to show you guys how we trade. Okay, let me see if I can raise the volume just a little bit. Let me know if that helps. I can also move a little closer to my microphone. Okay, thanks a lot, Morgan. Okay, so again, I appreciate you guys coming in to the 24-hour Trade-A-Thon. And the subject that I'm actually going to be talking about is in line with stock options, specifically trading the opening hour with options. Now, this is a way that we trade every single trading day, and I will go through the way we look at trading the open, why it's a good advantage to trade the open, how we use options to take advantage and leverage that opportunity, and then specifically how we do it with the various indicators that we use in the options live trading room, and then show you some examples so you can see exactly how this works, and then and I'll wrap up with some takeaways. And if I have some extra time, I may actually just pop over and look what the markets are doing now and show you some live examples. So we'll go ahead and get started. Okay. All right. If you have any questions as we go ahead and send them in via the side menu, and I'll try to address them as we go. Okay, risk disclaimer. This is our standard risk disclaimer about trading or investing, that it carries considerable risk, and that you should be able to tolerate risk based on your level of experience and investment objectives. Basically, the bottom line is that any past performance results are shown for illustration and are theoretically hypothetical. And then most importantly, past performance is not necessarily indicative of future results. The next disclaimer is the standard CFTC rule 4.41. And basically right there is saying that you should not trade with money that you cannot afford to lose. This is not a solicitation to buy or sell stocks or options, and that past performance is not necessarily indicative of future results. Okay. All right, let's go ahead and get started. The topic I'm going to be talking about, again, is trading the opening hour. Now, the thing about that is, if you think about it, futures, Forex, they pretty much trade 24 hours a day. I know there's about 45 minutes to an hour in which they don't trade. But with stocks that are listed on the New York Stock Exchange, the NASDAQ, there are periods of time where they don't actively trade on their home exchanges. So we actually have a formal opening hour every single trading day. So that provides us with some unique opportunities. Now this is how most amateurs view the market, the stock market. Say, it's wide open, beautiful, full of potential and opportunity. Now, the funny thing is, that's not necessarily what's waiting for them. Lots of times, this is what you should be looking out for. when you first step into the markets. You know, welcome to the wild world of trading. There's a saying on Wall Street that goes, amateurs open the markets, professionals close them. Now, what exactly do we mean by that? Um, when we look at a normal daily bar chart, so each bar is one day, usually the open and the close are at the opposite ends of the bar. I always tell my room, take a look at, divide the daily bar into thirds, and usually you'll find them, the open and the close, at the opposite ends of the bar. Usually what this means to me is that when the markets open, it usually is the case by the end of the day, prices are have moved away from those, usually in the opposite direction. Okay, so right here you can easily see that. You can see that here is, that's the open. Oops. And this is the close. You can see opposite ends, okay? And it's usually the case on every single one of these bars. And if they do end up in the same spot, like this bar right here, we actually have a name for that, and that is a doji. Hold on here. And that would be this bar right here. Oh goodness, it's just my cursor, but it's this bar right here. And when you see a doji pattern, usually it reflects a lot of indecision in the markets. It's usually the case when the markets can't decide to go up or down, that that usually it's the case that we're not sure which way the market's going to go, and it usually takes another bar or so to resolve itself. But thank you for that note. Yes, I agree with you, David. Candlesticks would be a little better. The one feature that we have on this particular chart, we call it value bars, and I'll get into that a little later. It actually doesn't appear as clearly with candlesticks. But I just wanted to show you and illustrate the idea that the open and the close are usually in two different directions. Okay? So specifically the traits of the market open. The opening of a market can provide a clear view of the imbalance in buy or sell orders. Normally, amateurs, people that actually work and try to trade in the evening or early morning, they can only place orders before the market opens, before they go to work. So what happens is if someone reads an article in Barron's over the weekend, or if they or Investors Business Daily sometime during the week, and they decide to buy or sell, they have to place it before the market opens. And usually what happens is those orders stack up, and the market makers have all their orders before the bell opens. Now, usually when there are more buy orders, market makers see that there's an imbalance, so that there are more buy orders. So they have to fill those buy orders. So what they do is actually open the prices in the stocks higher when they have more buy orders, and then they basically fill the buy orders at the higher price. And once those buy orders run out and prices balance out, then prices generally drift lower. And then conversely, when there are more sell orders in hand, the market makers tend to open prices lower. They fill the sell orders down there, and then when the imbalances resolve themselves, they usually float up. Okay? All right. So again, when imbalances correct, the prices usually move back towards the gap, and then market makers balance their account and basically collect their profits when the gap fills. Most institutions are aware of this phenomenon, and they basically usually wait for the gap to fill before entering new orders as to when they're adding more to their mutual funds or things like that. Now, not the gap does not always fill, and there are those runaway gap times in which the stock is going to make a major move, and then there is a gap, and then just during that first day, the prices move away from the gap. And occasionally we do run into that, but there are indicators that we use uh, to identify those particular runaway gaps. Now, but in essence, what I'm trying to get to is basically the smart money waits until the amateurs are eaten first. Okay, so basically as a professional, this is the way we see the open. We have all the amateurs, the bait fish here, and then we have the large professional predators come in here, and they take bites out of the small fish, and that's what we see happen every day at the open. Okay, so the next question is, how do we take advantage of this open, this phenomenon? Now, again, this happens the majority of the time. I can't say it always happens, and runaway gaps are an example of that. But the majority of the time, these trading setups are there for us to take. So basically, again, the question is, how do we take advantage of the opening? Basically, what we do in our options room, we fade the opening move. If the opening move is a gap to the upside, if the indicators tell us we can, we'll go ahead and fade that opening move and look for that pullback towards the gap. Lots of times what we also do is, the second thing is we actually look for that gap to fill all the way, or either 50% or all the way. Sometimes it happens really quickly. Sometimes it takes longer into the morning to actually fill. Okay, and then the next way, the third way we look to profit during the opening hour is we look for divergences in momentum and price on the second or third moves within a stock. Okay, let me just double check here as we're going, because we're going to the next phase. This is basically what I'm going to talk about for the rest of my time, but I want to make sure that we have some answer questions here. The size of the gap does matter, Jim, and I'll get into that. Also, another factor that goes into looking at the open is the strength of the move of the indexes. If the indexes are very strong, then and the gap is in the direction of that opening move in the indexes, that may not be the best thing to look for that particular gap to fill. But one thing that I will go into, I'll go into the different time frames that I use. I will talk a little bit about volume, but I don't necessarily use that in my trading room. But we also look at the indexes and how they're behaving. Okay, I think any other questions that are out there, I will touch on as I go through the examples. So I appreciate you guys asking them as we're going. Okay, but let me first touch base on some what we consider at Microquant the three components of technical analysis. This is important for me to touch on because they feed into the types of indicators that we use. Okay, the three components of technical analysis are price, momentum, and those two you're probably very familiar with. Third, value. It's the component that we are probably best known for with our value charts system, but it's something that's proprietary, so the chances are you haven't seen it before unless you've actually had the opportunity to see us trade with value charts. And it's a unique unique aspect of technical analysis that I'm going to be talking about more here momentarily. Okay, again, the tools that we use to view these three components of technical analysis. First of all, we have price. And in my trading room, I use the traditional price charts, the open, high, low, close bar charts. For value, we use our proprietary value charts and value bars indicators, and I'll be happy to show you that in a moment. For momentum, we use NQ momentum and a form of a squeeze indicator. I know Trade the Markets also has an indicator here, but it comes with our TradeStation, and it's also a momentum gauge. And then we also use trend identifying indicators produced by microquant. It's all known as NQ regression and NQ trend. Okay. Now, for those of you that are familiar with value charts and these other indicators, I just want to briefly touch on the different charts settings. We use a 5-bar analysis period for value charts and value bars, a 100-bar analysis period for NQ regression, which is trend following, and the standard indicator settings for NQ momentum and the squeeze indicator. Now, someone asked me earlier, what type of charts do I use at the open? We actually trade tick charts in the opening hour. And a majority of our intraday trading, we use tick charts. Okay. Now, I'd like to quick touch on the value bars and value charts indicator. Basically, with what value charts does, it divides prices into 5 primary valuation zones. Fair value, which is the green center region. We have a moderately overvalued and a moderately undervalued region. Those are the yellow bars. And then we have a significantly overvalued and a significantly undervalued area here with the red segments. And what basically this is telling you, it's almost like a value distribution profile in that prices are in the green fair valuation zone roughly 66% of the time. 16% of the time, prices are in the yellow overvalued and 16% of the time in the yellow undervalued level. Then we have the red valuation zones, and when prices touch those levels, they're only in those levels roughly 1 to 2.5% of the time. Now you have to keep in mind the definition of value we have here at Microquant. Value to us is basically is not like the traditional financial aspects that you might see on a mutual fund or something like that. When someone says something's undervalued or overvalued, those are someone's opinion. It's an analyst's opinion based on their analysis. What we actually do is we actually provide an objective evaluation based on historical prices going back through the analysis period. So when prices get are in fair value, like this zone here, prices are in the green, and that is in line with the historical objective valuation of these prices. Now, when prices start to move, and they move quickly or they move strongly in one direction or the other, then we get into the yellow and red zones. Now, usually it's the case when we move into the yellow and red zones that we have a higher probability of moving back towards the green. Again, because prices usually stay in the green fair value zone roughly 66% of the time. Okay, so it's an objective evaluation of the current price based on historical prices. I know it's a concept that's a little different than you've been exposed to, but it's a very consistent indicator that gives you a different look at prices than what you normally would have just looking at the charts themselves. Okay, now just again, touch base again. These are our traditional open, high, low, close bar charts. Right here is the bar charts with our value charts indicators. So you know when prices are in this area up here, that, or where they currently are sitting, this is in the significantly overvalued red zone. So what that means to me is if they're in the red zone, then chances are prices are going to pull back. Statistically, compared to the previous set of prices, this current price will probably pull back into the green valuation zone, or pull back away from this high. And now you can see with value charts, we look at the open, high, low, closed bar chart for prices, the stock prices, and here we're actually looking at their valuation. Now, if you're trading fast-moving markets, it's actually hard to read two charts at the same time. So we've actually combined that into our value bar system. Not only, and you can see here, not only can you determine where the price is, and therefore all the support and resistance levels, etc., but you can also see the value as to the value charts system, where stock prices currently are within this bar here. It's not. It's different from the RSI indicator, Butch. It monitors our proprietary idea of value, um, but it does also incorporate historical prices. Right. This is not a traditionally fundamental idea of value. We're not looking at the stock or the company itself. That's correct. Okay. All right, let's just go ahead and continue because I want to make sure we have enough time to see examples. I love showing you guys this stuff, but from being a participant in a lot of these webinars, I know what you're looking for. You want to see we want to see the profits. Okay, so let me just quickly touch base on this. The next two indicators are MQ regression and MQ trend. Basically, what these are trend following indicators, and it really doesn't come into play as much. Basically, you remember if it's red, there's a bearish trend in place, and if it is green, it is a bullish trend in place. This is these are MQ trend dots. Now, this is an indicator that I use that helps me set price targets when I have stocks moving in the direction I'm thinking they're moving. And usually it's when they actually come up and touch the MQ trend dots that they actually flip over to the opposite trend value. Okay, but for the purposes, I don't want to get bogged down too much in the specifics of this particular indicator or MQ regression. I just note that lots of times they allow us to set good price targets when the trade is working in our favor. Okay. All right. So those are our two trend following indicators. The next one is MQ momentum. This is very close to an MACD type momentum type indicator. It is basically a hybrid of a couple of different MACD type momentum indicators that our founder Mark Helwig came up with, and it's what we use in our MQ in our trading room. Basically, it's comprised of this solid blue line. This is the fast line. The dotted line is the slow line, and basically they measure momentum of the underlying stock. And when the histogram is red, the price momentum is bearish. When it is green, price momentum is bullish. The height of the indicator line relays the strength of the move, as well as the slope. The slope of this indicator line also relays the strength of the price momentum move. And when they cross over, it's significant because that's when it goes from green to red, and it switches from bullish to bearish. So we'll continue to look at that. What's important is it's actually good to show you how we use momentum in our intraday trading also. George, that's a good question. Let me go into our specific with our divergences because I think maybe that will answer some more of your questions. Okay. All right, guys. So that basically covers the indicators we use. And again, the question is, these are the trades that we do. We fade the opening move, we look for the opening gap to fill, and then we look for divergences on the second and third moves. Now you've seen the technical analysis part, okay? You've seen the indicators we use. Let me briefly touch on the examples how we use options here and why, and then I'll go into actual examples. Okay, so basically, when we look for the underlying stock to move either higher or lower, basically what we are doing is buying directional calls and puts, specifically the in the money weekly options. So today is Monday. We'll be trading options that expire on Friday. And someone always asks me, Dave, what about time decay and all that? Remember, the time frame we're trading is the opening hour. So from 9:30 until about 10:30, maybe even till 11 o'clock in the morning, you're not really worried about time decay. And especially since we're using in the money weekly options. Specifically, I probably already said it, but they're the Delta 70 options, calls and puts. Basically, if we think that the stock is going to go up, we buy calls. If we think the stock is going to go down, we buy puts. And how that translates to the actual gaps, if the gap is down, we'll buy calls because we expect the stock price to rise. If the gap is up, then we actually look for the stock to fall, so we buy puts. Okay? Hopefully that's clear for everybody. Excellent. Okay. All right. So moving on. So that's how we utilize, and we do have different strategies in the options room, but this is the one specifically for the intraday trading and specifically for the opening hour trades. All right. Now, why? Oops, I'm sorry. Why do we use options? Can't we just buy and sell the stock? And just one word that will answer that question. It's leverage. Okay. Leverage. You can control a very big position in a stock with options. Now, I'm not going to go into that, but those of you that are familiar enough with options, we narrow our focus to specifically just a handful of stocks. And they are the ones that have high options volume and liquidity. That's extremely important. Okay, high options trading volume. Now, these two factors are very important because you want to be able to get in and out of options trades very quickly. There have been times, sometimes these intraday trades, I'm in and out within 5 minutes. Okay, but you also want the volume there because with volume, it narrows the bid-ask spread. Because lots of times people say, well, Dave, I don't want to trade options because you see that bid-ask spread, it's almost 50 cents. Well, yeah, that is the case. But again, the leverage will also help with that. But I'll get into that a little bit later. But what's important to know is that the volume of the options trading and the liquidity and the number of contracts that are out there allows you to minimize that bid-ask spread. Okay. The next function, the aspect of the stocks that we want to look for are big stock prices. Okay. And tie that in with a large average true range. Why are these two items important? Because we want the stock to move, especially in the first hour. If the stock doesn't move, we can't trade it, and it has to move in a big enough dollar amount that we can scalp it, or we can take profits over a move of say several dollars versus a move of 10, 20 cents. It makes a big difference that way in terms of profitability. So which stocks do we use? We use Apple, Google, Amazon, Tesla, Priceline, Netflix, CMG. And I'll tell you, primarily what we trade, Apple and Google. Okay, this is a $500 stock. This is over $1,000 stock. The average true range in Apple is running anywhere from $9 to $10. And Google, it's running anywhere from $9 to $15. It just depends on the day. Okay. So when we trade a Delta 70 option and we catch a $2 to $3 move, it can make for significant profits in the in trading every morning. And I'll show you in the examples. Okay, I'm just double checking my time. Julian, that's a good question. When do I determine when to get into the stock? That's exactly what I'm going to show you now. Okay. All right, guys. I don't see any more questions here, so this is good. All right. Again, the first type of trade that we take, we fade the opening move. Now, hopefully you can see my cursor a little bit here. Okay, I see that you see it. Good. All right, this is Apple. Again, we trade a 250 tick bar chart. I don't want to get into the specifics right now, but with the tick charts, we tend to be able to capture the opening moves more efficiently than we do with, say, the 1 minute or the 5 minute uh, uh, bar charts, time bar charts. Okay, so as you can see here with Apple on this particular day, Apple gaps up here, and the gap at the open is plus $2.50. So we're looking for the opportunity. Right? We can see momentum is up, the trend is up. Again, we don't necessarily watch this trend to determine which way we trade. And I'll go ahead and answer the question now. Most um, most trades that we take are counter trend. Okay, most trades that we take in the opening hour are counter trend. So again, here's the gap up. We see momentum is green, so we continue to watch it until this point right here where the red arrow is. At this point, we see momentum start to fade. Squeeze is still going up just a little bit, but this is at the point when we get to this bar moderately overvalued, okay? We go ahead and buy Delta 70 puts. Okay, price right here is prices push up towards about $519. We go short by buying Delta 70 puts, and prices start to fall. Okay, they start to fall. Now, the first time we get a moderately undervalued, we can go ahead and take some profits on some of our puts here. As you can see, momentum is falling off. Now momentum is actually red. Now, one trick we use in the options room is you see the indicator line actually still has a negative slope to it. So as long as we continue to have a negative slope and it doesn't turn positive, we will stay in this trade. So it does bounce up just a little bit, but then it continues lower. And to this point right here, where the indicator line actually goes positive, and we can go ahead and sell out of our remaining position. Okay, this move in Apple from up here to down here is roughly $1.50 to $2 based on where you took your profits, or if you took some here and then you took some here, that is $2. Okay, let's just say it's $1.50. Now with Delta 70 puts, we roughly make $100 to $150 a contract here. Okay, because you have to multiply $1.50 by 0.7, okay, or $2 by 0.7. So we roughly make 100 to 150 per contract. Now, with that being said, the option normally runs you anywhere from $900 to $1,100. Okay, the options are usually $9 to $11. So you can tell that if you're buying an option for $10 and you're making 150 on it, I mean basically $1.50, that's about a 15% return over the course of just a couple of minutes. Okay, so that is the first example of fading the opening move. What specific put did I buy when Apple was here? I bought specifically the weekly that expires, if it was today, the weekly that would expire on Friday, and I would buy specifically the in the money Delta 70 put. Delta 70 put. It's in the money. Okay. There are times when Delta 70 is not available. I'll buy a Delta 80, Delta 85. Later in the week, it tends to be higher deltas, but it doesn't matter. And what's important is that you're buying something that's in the money that can help you capture the value of this particular move. Okay. Do I use stops? Yes, I do, but most of my stops are mental. Usually when I trade, I have a lot of support and resistance levels on this chart based on the previous day's highs and lows and pivot points. Historically, where we have these resistance, support and resistance zones. So that, and also one thing you don't see here is this is a 250 tick bar chart. I also trade with two charts. I'll trade with what I call the half size chart. I'll trade with a 125 tick bar chart, and I'll trade them side by side. Usually I will look to the shorter term time frame for a move first, especially when I'm trading divergences. But sometimes the squeeze indicator starts earlier, so I already see momentum is going down here. Question is, does the gap fill more on specific days of the week? I wouldn't. It depends, George. More so, that is more important with indexes, and that's when you're looking to fill the entire gap. For me, I'm looking to scalp certain types of setups in the first hour and a half. Yeah. There are some days I would say my least favorite day is Monday. And then usually when we have options expiration or something like that, I tend to be more careful. I'll still trade, but I tend to trade smaller size. I don't do earnings reports. Nope. Anything that's a news-driven, volatile type session, I don't necessarily want to do that. So let's go ahead and continue. I see good questions coming through. I'm trying to touch on them, but I want to make sure I can get through my examples, maybe show you something live, and then wrap things up so you guys can have a takeaway. All right, so that's fading the opening move. The next kind is here in Google. Notice we use a 75 tick bar chart, and again, these are calibrated to the particular stocks. But here's Google. We actually gap down at the open. Now, Google is what I refer to as a battleship. Okay, Apple is like a sports car. It's like a destroyer. It can turn, it can weave, but it's small. It doesn't have necessarily the size of Google, which is my battleship or cruise liner. So you can see Google gaps down, and it tends to bounce right on these MQ trend dots. Now, these MQ trend dots actually identify support and resistance level, and you can see how momentum dropped. I mean, it's strong at the open because of the gap, but we tend to go sideways. We bounce right on the support level, and when I see momentum start to fade and start to fade on the other tick chart, the half-size tick chart that I have, I start looking for this to fill the gap. So on this bar right here where we start moving higher, you can see momentum is actually waning, and momentum is actually has a positive slope on our indicator line. Here I will actually buy Delta 70 calls because I want the price to go up. That actually fills this gap, and we actually buy the calls, and the prices move. They actually fill the gap. Now, we can take profits here at the moderately overvalued level, but we see that the indicator line is still positively sloped. So it's okay for us to go ahead and continue to hold the calls, let them appreciate as the stock moves, because what this indicator line is telling us, as well as the squeeze histogram bars, is that we are continuing to be bullish. So we'll go ahead and continue to hold that until this indicator line changes its slope from positive to 0 or flat. And we do that all the way up here. Now you could take profits here. That's okay. That's when it first starts to inflect and become flat. Or here, if you're hoping for more, but this is a gravestone doji right here. And here we have a yellow overvalued level. So once you see that, normally that's when we get out. Here also the MQ momentum, the histogram bars are starting to fall. So it's okay. We'll take what I call in the room the meaty part of the trade. I don't have to get the ends. I just want the big middle. Okay. Now, again, the reason why I call Google my battleship is because this move, it's $1,000 stock. It moves almost $10. Okay. This is still a Delta 70 call. So if it moves $10, basically what we're doing is making $7 per contract per share, or $700 on this move alone. And usually these options in Google run anywhere from, depending on which day of the week, roughly $15 on average. So that's a very strong move. Okay, that's an example of a gap fill trade. Normally, you'll see moves like that, and again, like in Google, because it's such a powerful move. The one thing that I always tell people to be a little careful with is the fact that the height of these bars are kind of tall. This might be $1.50 tall bar, so you need to maybe use fewer contracts here. Yeah, Scott, you're right. You don't always have to catch the whole move. You're right. George, you're asking me where is the value part? Where do value bars come in here? They actually come into play, and especially when we're doing divergences. In this particular case, when we're just using the gap fill, because in a way we're going with primarily a momentum type trade, they usually provide me the ability to see when to get out of this trade. Okay, but you'll see it more so in divergences. How do I close the position at the market price? I basically go in and I sell. Usually when I get in, I use limits because I don't necessarily have to get into a trade. But if I try to use a market order and I get a bad fill, it not only increases the risk that I have, because the stock actually has to move in the direction I'm expecting it to move to at least to catch up to that bad fill. So I'll use a limit order to get in, and if I put a limit order in on this bar, I don't get filled and it takes off, I don't chase it. I'll just shake my head and say, hey, the next trade's coming along. I don't worry about the ones I quote miss. I will worry if I get a bad fill and this thing never gets to the profitability that I expect it to. I don't necessarily care that, oh, I only got $7 of this $10 move. That's fine. But I'm more concerned about my entry and not taking too much risk. And you'll see that on the next slide. Okay, this particular trading platform is TradeStation. Okay, let me go ahead and keep going, guys, so that I can show you some more examples. Okay, because I have about 25 minutes left here. Here's an example here's the open right here. You can see the close was here, the open was here, no gap. And sometimes there's a gap, but it especially like in Google, not much is going on, just bouncing around. Prices come up. They come up here. What I noticed on this particular trade, oh, I'm sorry, one quick question before I jump all the way back there. I'm sorry. The question was, how long did this trade take? Okay, and let me jump one more, back up one more. This move in Apple, again, this is a tick chart. So ticks come back much faster right at the open. This probably took about 5 to 7 minutes, if that. Okay. In Google, this move here probably took anywhere from 10 to 12 minutes. Okay. You notice it's about the same number of bars. The problem is there is more trading volume in Apple than there is in Google. So this takes a little longer to develop, even at the open. Okay. Now this divergence trade. This is Google again. Prices are bouncing around. Now this is all within the first hour. So I would probably say this is probably right around 10 o'clock going into for the next 15 minutes. Okay. But here we see Google bounce around here at the open. They go higher, starts to make a move. Okay. It pulls back. It makes a higher high. And look at the momentum structure. Look at the histogram bars. This is the first set of momentum bars, momentum histogram bars, and compare that to this high. Compare that to the second higher high. We have momentum much weaker, gradually, I wouldn't say significantly weaker, but discernibly weaker. Now you have an indicator line. It reaches this high up here. It doesn't even reach the plus 25 level here. So, and to answer your question, George, notice how the value bars go up from here. Usually this happens quite quickly, but the fact is we actually hit this 1040 level and we start to fall. The reason why we have a lot of confidence buying in this area is because we are at significantly and moderately overvalued. It's not in fair value, but we have value saying it's okay to buy, and we have momentum pointing down. Now, someone asked me about the squeeze. As long as we're not moving in with positive momentum like this on the squeeze, I'm okay taking this trade. Okay, I don't normally compare the two heights as a divergence, but you can. I look for divergence on momentum. The squeeze just keeps me from jumping in because inherently squeezes are counter trend. Okay, you can see MQ regression is actually green, but what the squeeze does, it allows me to confirm that we're not still powering up. Okay, we're not still climbing like this. We're actually weakening and starting to decrease. So it's okay for me to go ahead and take this as a divergence now, because occasionally at the open you'll see where the market is going up like this. You'll see what it looks like a divergence, but the squeeze is still pointing up, so I don't want to take that yet. Okay, George, yeah, you could probably do that. I don't mind seeing the value bars because this right here is usually occurs when things are going quickly. It's called a value migration. But here, when it jumps back to the yellow, that's usually when I get in. So with this particular move, you see the divergence. You see profits continue to fall. You see the indicator line develops a negative slope, and it continues down to this point here. Okay, squeeze bars are going down here. Now, I want you also to keep in mind that I trade these with a very keen eye to support and resistance based on a daily chart, and I apply them to the tick charts when I trade them intraday, because those provide me with levels for these things to bounce off of or bounce up from. It gives me good price targets to see where prices are going. In this particular case, prices fall and they actually hit right around these MQ momentum trend dots, and I usually take some profits right around there. If it starts to fall, I look at that as a good spot to take some profits. It bounces and it continues lower. You can see the indicator line is still has a negative slope. Okay. Mary, that's actually kind of a complicated question. What do I use for support and resistances? Basically, best way to describe them are points of inflection on the daily chart. I use daily highs and lows also, but I also like this right here. Prices come down and they bounce. This area right here is a point of inflection, so there would be a support level based on the lows of these two bars. Same thing here, same thing in this area, okay? But right here, this particular move, uh, George, I like tick charts. Yeah, I like tick charts because it reflects the trading activity in the stock. Let me continue because I only have 20 minutes here. So this is a good example of a divergence trade, and roughly we made, this is a $7 to $11 move. And again, what we're talking about when we're um, profit wise, we make roughly $9 on a $15 option with this move. Okay. Now I picked these examples because they're pretty clear examples of divergences, so I can illustrate them. But let's just back up. And this is an actual trading hour. Again, this is Apple. This is kind of my sports car. Okay, it gives me multiple opportunities to trade. Now there are different types of combinations. Here we're fading the open. All right, this is not a complete gap fill, but we'll trade from up here, hopefully you guys can see that, to down here where the blue line is. I took that trade. Now we bounce along sideways here across this 535.82 level. That is a pivot point that I identified on the daily chart. And as we're watching momentum, there's not enough upside momentum to break through that. It falls some more right down here to this yellow line. Now this yellow line corresponds to yesterday, or quote, when I did this chart, yesterday's previous low, previous high. So it falls here. So we can, here we're buying Delta 70 puts. Here we're buying Delta 70 puts. Here we bounce off this 529.70 level, this low to this low. And what we have here is a divergence. Okay, and it bounces higher. Sam, I'm going to get to your question in just a second. I will have that for you. Okay, so we buy Delta 70 calls here. We trade sideways along in this channel. What do we see? We see a bit of a bearish divergence, but I'm watching momentum. And you see on the squeeze, we break lower. We trade this break of support that we established over here. It falls, and then we get out right here around 525. It bounces. Now I could have held it longer, but I remember I didn't because I was thinking I was going to take some profits at 525. We actually come down here. We make a bullish divergence. See, this is the momentum for this move down. This is the second move lower at moderately undervalued. See the NQ momentum, the difference in the histogram bars. Trade this higher, take some profits here, but we are actually trading something else. So what we actually have here is another divergence from this low to this low off of this 525 level. Okay, this is the type of trade I love to take because 525 for Apple, and because we trade it every day, we know where the support and resistances are, where they tend to bounce off. And 525 is a very nice level, and we just run up with Delta 70 calls here. So in the first hour, trading Apple, we have 1, 2, 3, 4, 5 trading opportunities. And what's interesting is there are some mornings where we bounce around like this, and by the end of the opening hour, by 11 o'clock, the price is in exactly the same place as the open. So most traders will look at that and say, Apple didn't go anywhere today. I'm not making any money. Or with us, we're making money here, 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 and here. And by the end of the day, we're back to where we started, but we made money based on this intraday move. Okay? All right, somebody asked really quick, I'm watching my time, and can you show us something that's more current? Now, if you bear with me, I want to see how I can squeeze this in here. This is my trade station from this morning. I'm going to make it a little bigger so you all can see. All right. Again, so this is real time. This is Apple. Let's take a look at it. All right. Hopefully you guys can see. I'm going to zoom out just a little bit. All right. So Apple, we had a little bit of run in it this morning, here to here, and this. again, apologize for the highs and lows. I didn't update them today because I was preparing for the session today. But you can see prices are bouncing along nicely. Here's first high, second high, third high. You can see this is a double bearish divergence. We could have taken this one because, again, here's that 525 level and then taken profits here. And this is a previous day's support level. But if we're following the MQ momentum indicator line, it's continuing down. So from right here, 525, down to here to about, what's that, 523. That's a $2 move. Okay, continue to watch it. We come back up here, retest 525. Now, we're not breaking through. And if we watch momentum, there's a good chance we can actually catch this type of move. Lots of times I see this when it's a try to break out through a strong resistance level. We don't do it, and we can see clues on MQ momentum that we're actually going to fall back. And I don't necessarily get short right here until I actually see it start to tip. And sometimes you see that on the half-size tick chart or the 125 tick chart. And then we'll fall here. Now you can get out at significantly undervalued. That's what I use this for. Or sometimes down here on the support level are these MQ trend dots. That's about $1 scalp right there. Now, right now we're just wandering sideways. And again, this is basically 10:30 right here. So this is the opening hour. That's what I saw in Apple. You could have traded this move here, this from this high to this high. That is a bearish divergence, and the indicator in the squeeze is falling. It's very tight though. You hit moderately overvalued and you sell it moderately undervalued. Okay. So that's a little. I mean, this is not a perfect world. So you have to trade what comes at you. But there's a couple opportunities there in Apple this morning. Here in Google, my battleship. Do you see how many ticks there are? Yeah, most of the trading is quick, Julian. So we continue to go up here. Here's a bearish divergence. First high, second high. Momentum is barely in existence here, and the squeeze starts to fall. On the half-size tick chart, this is very evident. And then you can go ahead and buy Delta 70 puts here. Falls here to significantly undervalued. Chances are I would have sold some here, but the squeeze is still going. The MQ momentum line is still negatively sloped, so it can continue to go down to here. Take some more profits here. Okay. Here, from this low to this low, that is a bullish divergence. Squeeze bars are going up. So you could actually trade this from 1036, and then the indicator line still going positive to about right here. Plus it's significantly overvalued. Okay. So that right there, that is a $6 move in Google. Right there. Very nice divergence there. Okay. Like I said, we're basically using value bars to help us get in, how to get out, using MQ Momentum's indicator line to see divergences, as well as the indicator line, the slope of the line to verify the speed at which this is falling, and also where it changes slope. The squeeze bars also help us because they show that we can get on this trade to the downside because the squeeze bars are actually falling. So that definitely helps us. Yeah, I mean, and this is what I can show you. These are the actual trades that I would have taken in the trading room today had I been in there. But the opportunity to show you guys stuff in here. I mean, that's as live as you can get. That was TradeStation. I trade my charts on TradeStation, but I use Thinkorswim as my entry platform. It's just I'm more familiar with TradeStation. So that's what I have for you. Again, those last examples, those were live. All right, let me see if there's any last minute questions. Can this be automated? George, this is hands-on trading because you can see how many. I'll tell you, it's very high probability trading. You can go back in my trading room, and you can see the trades we take uh, a lot of trades, and we're actually very consistent in with our profitability. Uh, do I use stops? Um, I have mental stops based on as long as the trade does not violate my idea of um, my idea of the trade. Like in this case, as long as this divergence is in play, you can see the differences in momentum. It's not a broken trade. So this can go up just for a little while. Now, I'm not saying the stop is way up here. It's not 10 points or something like that. But here we're hitting moderately, significantly overvalued. I get in right here for a particular reason because I see that there is a divergence forming. I see that the squeeze lets me get in there. I see that we're moderately overvalued. Okay, you can see when the trade breaks because momentum will automatically jump up, and the squeeze will change, and prices will start changing to the upside, and then the divergence that I was trading is no longer in play. I don't have to put a number on it saying that, oh, I have to take it here, or if it's broken at 1042, well, I'm not going to wait till 1045 to get out. It's broken. If the criteria that defines this divergence, if it's not there, I'm out. Okay. Yeah. Very good question, Annette. Divergence. It's too subjective. In essence, the essence of divergence tradings is subjective, Scott. I mean, that's why you actually have to see it done and actually practice doing them. Yes, they don't work out all the time, but the way we make it high probability, I would probably say I take anywhere from 7 to 8 trades before I have one that actually goes against me. Everything else is profitable. Why? Because we use different factors. We use momentum, we use value, we utilize this squeeze to keep us on the right side of the trade. I actually use the NQ regression line, the slope of that, to also help determine whether to take a trade. I use 2 different time frames. I use the full size tick chart, like in Google. I use a 75 tick bar chart, and I also use a 38 tick bar chart. Okay, yeah, well, basically, when I trade these setups intraday, I make anywhere from 800 to 1,000 a day, trading 5 contracts. Okay, and there's sometimes when I take divergences later in the morning, if there's a really nice setup. There have been days I make a couple of thousand, and that's just the intraday stuff. That's not the swing trading stuff in the trading room. I'm using all the indicators I showed you, BJ. All right, so let me just give you a couple of takeaways here. I mean, the question of it is, I'll tell you the honest truth. As a trader, you have to learn how to trade, and to me, don't necessarily rely on some automatic system that someone is providing you. You got to learn how to use your indicators yourself. You got to actively trade the stocks that you follow, and that you got to be able to practice and gain experience in doing that. That's the only way you can treat this as a craft, as a professional, and actually be successful trading, because the markets change all the time. All right. Sure. All right. So basically, right here, takeaways, because I only have about 5 minutes left in my session here. Keep in mind, the opening hour of the stock market provides you a really good opportunity to take advantage of that buy-sell imbalance. And you can trade this consistently on a daily basis. The market always has a defined open, okay? Now, it doesn't mean that that opportunity will be there every single day, You can see where I traded Google before that big move. It's like there was no gap, or the market was flat. Then you can't do anything there. But you can watch the behavior of that stock, and maybe something else will show up later on in that first hour. Okay. The next point is weekly options traded on actively traded expensive stocks give you probably the best opportunity to leverage your trades. Okay, think about it. You got Google. It's a what is it, 1,040, whatever the value is this morning. It's a $1,400 stock. You trade it with a call option that costs you anywhere from $15 to $17. If that's not, and then that thing has the opportunity to move anywhere from $5 to $7 in one trade. That's a tremendous amount of leverage. Tremendous. You only need to trade one contract. If it moves $5 in your option, that's a $500 trade right there with one contract. Okay. And the other good opportunity with that, let's say you bought that $1,500 or $1,700 option. If something really terrible exploded and you lost half the position, you still only lost 750. 750 compared to ability to make $500-$600. Okay, but it's not something that we set and forget. We actually get in, we monitor the trade, and we get out. Because we're trading within that first hour, we can actually focus and trade. We're not going to leave it alone. We're going to decide, are we in, are we out? We're here to make money. Okay, so and the last thing is this is an intraday trading strategy, 1 hour per day. And the way I always tell everybody in my room is it's our daily take-home pay. Okay, make money every day, take it home, keep it away from the market. Okay, all right. So with that said, what's the best way to learn the strategy? Take some time and visit my options live trading room and watch us trade it live. You've seen my live screen right now, and I pointed out some opportunities I would have traded this morning. And you can see that there's a couple of more. You can see that the trades and the profits are real. Someone asked me, different indicators, what's the time frame, etc. I actually go through and I teach a lot of that stuff in my trading room. So it's a great opportunity. I have a lot of people that try my trading room, and they not so much are they making it. It takes a while to learn how to make money, but by being in the trading room, you can actively ask questions while you're in there. Okay, this is the options live trading room at Value Charts. We trade primarily options on stocks: Apple, Google, Amazon, Goldman. You can see the list. It's called their price line. We focus on intraday trading and some swing trading using selling credit spreads. A lot of the same ideas, but applied to a longer term time frame. Intraday, we use directional puts and calls. Weeklies on weeklies, and then throughout the week we actually use spreads. Our trading room hours are 9 a.m. to 1 p.m., so 4 hours a month. Normally, it's $149 a month. That breaks down $149 a month for 80 hours. 80 hours of live trading. That's $1.80 a month. I mean, $1.80 an hour. I can't get my neighbor to cut my grass for $1.80 an hour. Okay? That's my email address at Microquant. If you have questions on this presentation or in the trading room, please contact me. I'm more than happy to answer your questions. Okay? Now, with that said, with the 24-hour Trade-A-Thon, I have a special deal for you guys. Okay? Some people say, well, it'd be nice, but I don't want to put out that much money right at first. And I can understand that. You got a lot of stuff going on right now. But right now we have a special. Okay? Thank you very much for that. Morgan's put the link there, and I will show you exactly where that is. It is, thank you very much for the discount code too, Morgan. That is a $7 first month subscription. After that, it reverts back to the 149. But hopefully, you come into the room, you experience the trading and the camaraderie. There's a lot of camaraderie in our room, and you become a better trader. And then the $149, you know, that's just your cost of doing business. And you know, you enjoy the room so much. We make a lot of money, folks, consistently. Now I can sit here and tell you that, but come to the room and you can see it. Okay, that's all I mean. I can't show you anything else. I'd rather show you live and prove it to you. Okay, there's the discount code. Now where it is let's just see here. This is the options trading room right here. Go to valuecharts.com. Here's the options room. It looks like this. Go ahead and enroll now. And then you sign up for the subscription. And on the second page where you're entering your credit card information, use that VC Options 7 code. Okay? If you have any problems at all, send me an email. Again, it is dave@microquant.com. I'll be happy to help you make sure you get set up. And then I'm actually going to be having a special session before our trading room next week when we start back up again on Tuesday because of the holidays for anybody that's new to the room. I'll explain all the trades and everything so we'll be all ready to go when the market opens at 9:30. Okay? Well, Morgan, thank you very much. Thank you very much, everybody, for your time and coming into the 24-hour trading-a-thon, and I appreciate the opportunity to talking to you guys today. Again, let me know if you have any questions. It's dave@microquant.com. All right, thank you. Let's see. All right.
All right, great. All right, great. Thanks, Dave. We appreciate you being here and being a part of this event. Like I said, it was Dave's first time at the Trading Pub, and thought he did an excellent job, and you guys can check him out. So again, if you go to this link here, when you click the enroll button and you use the discount code, I'll type that in again, the discount code VC capital O for options 7, and that will get you 30 days for $7. So again, 30 days for $7. So I think that you guys will enjoy that and get to hang out with him over the next 30 days, hopefully. And Dave, thanks again to you and for Drew for being a part of today's event. All right, well, we're doing a pretty good job here on time, guys, kind of sticking to the schedule. So at this time, I'm going to turn things over to our next speaker, also making